Okay, Friday afternoon, I'm going to go live for I think what might be a relatively short video. And I think I got the volume issues worked out that have sort of been plaguing some of these live casts in recent days. Bottom line is I figured out I had to crank the volume higher for the YouTube lives than I do for pre-recorded videos for whatever reason. Anyway, here we are. So I'm looking at stocks that went public in the last 5 years that are profitable and that have strong charts. So starting here with something called the Revolve Group, which is a fashion apparel retailer. And then we can pull over here to a weekly chart. We see that it went public back in 2019. So that's very new. Stocks within about their first 15 years or so, believe it or not, of going public are often poised for big gains. That's many times when companies do make their biggest gains is within those first 15 years. Makes sense. You know, you have a newish product or service. You have management that is very eager to kind of make their mark and grow this. You have something exciting in the value proposition. So new is a big deal, does make a splash. So that's what we are seeing in a lot of these. So over here in the Revolve Group, you see a good history of earnings growth. I'm looking right here. You've got earnings acceleration in 1, 2, 3 quarters. Little more if you actually kind of look at the, there we go. So I made that area of the screen a little bigger. If you include, start with the downturn, then you rose from a downturn, so then it would be 4 quarters. Revenue is growing again after some declines. Now, this is what's interesting. Revenue was declining before the 2020 pandemic lockdowns, okay? So you had 23% growth, down to 22, down to 16, down to 6. So what does it look like going forward for the earnings? What do the Wall Street analysts think? And remember, these are the people who talk to managers, who study the supply chain, who study the company's fundamentals, study their financials, talk to the company, look at what's going on in terms of the sales. I mean, I remember back in the old days, this is not really done so much anymore, I don't think, but back in the old days, some of them would actually sit in the parking lots of companies and retailers and watch customers come and go. I don't think that would work so much anymore as an indicator, but you do see there's a lot of ways that analysts do make their forecasts. So looking at a 6% earnings growth in 2021 up to 26% in 2022. I like that 26% a little better, but you got to start somewhere. Company never did post a loss, okay? Even in 2020 with all the lockdowns and everything that went on, we do see that there was a 79 cents earnings per share. That was actually growth over 2019. So we do see yearly earnings growth acceleration. That's a good thing. Stock is trending higher. Now, yesterday was a bad day in the market, and this stock declined a few more days. So not surprising to see. Let me pop back over to a weekly. You're seeing it's down for the week, but actually, no, only about 2.5%. So that's not so bad, down $1.81 for the week. So that one's looking pretty good. Let's go over to a daily again, and we'll see. Could this be something approaching a buy point or in buy range? Well, yes. Yes, it absolutely could, because it pulled back from that high from July 6th. That was Tuesday, 73.38. So it rallied to a high before it pulled back. Found support very nicely there at around the 21-day moving average. That's this one I have right here, the pink line. Very nice rally today, up let's see, 7.9% today. Ideally, you'd like to see heavier volume, but it's a Friday. It's a short week, even though last weekend was the holiday. Not too surprising to see light trading volume kind of in the middle of July, in the middle of summer. Yes, the human factor does make a difference. Despite all the algorithms, if the people aren't around, that can make a difference. Okay, let's move on. Inmode. This is an Israeli-based company. I've shown you this one before in some videos because it keeps popping up on my screens. They make equipment for cosmetic surgery. Apparently that's a growing market with everybody seeing themselves on Zoom right now. You sit there on those Zoom meetings and you just look at your own picture there. Not that I've done that. I've heard that people do that. So, cosmetic surgery up because people are seeing themselves on video more, seeing how they look. Good history of revenue growth right here. You know, you had one decline. The quarter ended June 2020. That can be explained in many businesses, you know, even though this one was not necessarily, well, yeah, I guess you could make an argument that there were pandemic concerns. First of all, a lot of companies were just very concerned about the economy in general and shut down a lot of their spending in the first and particularly the second quarter of 2020. And then also what happened? Probably a lot of these cosmetic surgery clinics were temporarily shuttered, right? So they might have held back on some of their equipment orders. Over here, you see some earnings declines in those quarters as well. Once again, the company remained profitable despite earnings declines, and you did have yearly growth. So you had 177 per share in 2019, up to 211 per share 2020. Analysts looking at 30% growth this year, 8% earnings growth in 2022. Let's look at what's happening here. So it broke out of a cup with handle base, and I will show you that in a little more detail. So here's the cup shape where my cursor is, right over here, formed a handle, okay? This is really textbook. I love this. You want to see a proper handle take shape in the top half of the base, and you want it to form over a minimum of 5 trading days. So here you had, see that? Looked like a little rally attempt, then it pulled back again. That was day 2, day 3, day 4, day 5. Okay, so you see that right there, 5 days all below that handle high of 87. Then what happened? Boom, we had a gap up right here to the tune of 5.05%. The 505, that's an area code. So you saw that gap up to the tune of 5.05% on June 7th, and volume was 219% heavier than average that day. So that's what you want to see. And kind of trended higher there. You see that? That's the green line is the 10-day moving average. Pulled back. Once again, I see something I like there. It found support right at that 50-day line. So when that happens, it's an indicator that either the traders themselves or the algorithms that do the trading or a combination of the two, okay, are saying we still want to support this stock. And we are going to get in here at a little cheaper level, buy some more shares to add to our position. That's institutional buying at work, folks. That's not the Reddit, Wall Street bets, meme stock crowd. That is what institutional buying is here. And let me just take a gander at the market cap. So this is the mid cap, 3.5 billion. And you've got 195 funds in the most recent quarter. So you do see some pretty good institutional buying. This one went public in August of 2019. Very much new, very much in the realm of what you want to see here. A lot to like about this stock right now. Okay? A lot to like about that one. Let's take another one here. D Local Limited. So this is a Uruguayan company that runs a cloud-based payment service. And I think, you know, it's funny because all the stocks we're looking at today tell you something about where we are in kind of the digital economy, the post-pandemic economy. I mean, you can make a case for everything with that right now. We looked at Revolve, the clothing group. Well, what's happening? People are buying clothes again to get out and about. You know, I explained the business case for the maker of cosmetic surgery gear, right? Again, that's not just a Zoom play, but it's an out and about play as well. Now this one here, it's very newly public, just went public back in June, brand new to the markets. Not too much we can say about the pattern at this point. I will take a look at the stock, we'll talk about it. But cloud-based payment services with more and more things moving online. And I like the fact that it's in Latin America. That tells you a lot about the globalization of the cloud-based payment industry. So really like that one a lot. Let's pop over to a daily for dLocal. Okay, so let's talk about recent IPOs and what tends to happen with these stocks. So this rallied higher. Let's see, looks like it was priced at 21 per share to go public. So it rallied higher than that, well higher. So it looks like it finished the first trading day at 32.39, then rallied again, then pulled back. Not unusual, okay? When you see something like this that's brand new, just public, don't feel like you have to jump in and buy this thing. Now, this isn't really one of those dLocal. I mean, nobody's heard of it. It's a smaller company. Let's check the market cap over here. Well, it's 14.58 billion, so it's not that small, but it's new. It's relatively unknown, compared to some of the bigger American stocks that are kind of household names. But I use the example of Facebook a lot back when it went public. And I'm going to do that again right now. Bear with me while I kind of fumble around here and find the exact dates. Yep, got it. Okay. So I'm actually going to go to 2014 for Facebook. We're going to go back in time to 2014. Okay. So here's what happened with Facebook. You had the IPO priced at 38. It rallied, fell immediately. Now, this was 2012 when that happened. I actually remember this very well because I was following the market back then. I was in the financial business back then, as I am today. I remember a lot of talk about the Facebook IPO being a failure. And, there was a lot of schadenfreude because why people love to hate Facebook. That was maybe more true today, but it was true back in 2012 as well. And you see it corrected. Then it tried to rally, corrected. And it took up until, let's see here, it took until, I'm going to call it September 2013 before this thing got back to its May 2012 levels, right at the time of the IPO. And if I'm going to reset this to today, then, go out to a monthly chart and get a longer term view. Well, there's Facebook. So what's the point I'm trying to make? You didn't have to get into this thing until 2013 when this really proved itself. Because why? Otherwise, if you thought, oh, this thing is big, it's bound to be a winner, it's so great, I have to get in there. Well, you would have missed out on, actually not missed out, you would have had to sit through a lot of declines. It might have been very frustrating for you, and you were better off waiting. That is just the story of every IPO. You are better off waiting until it passes a strong technical buy point, one you can identify. Now, in this case, you could have made two cases maybe. You could have perhaps said that 32.51 from January 2013, that could have provided you with an early entry point. That might have worked. But you know what? You were still looking at August, or July rather, of 2013 before you were able to get in there, even with that lower buy point. Wait. When you see a new IPO, wait for it to pass a proper technical buy point. I go over that a lot in my videos. So that's my little lesson about Facebook today and about dLocal. So let's look at the fundamentals of dLocal. So you have earnings of 5 cents a share in 2019. Obviously, all of this is what the company had to report before it went public. They have to report their prior financials to regulators in order to just compile the story of the stock so everybody knows what they're buying into prior to the time it actually does go public, okay? So 5 cents a share 2019 up to 10 cents, expected to more than double, significantly more than double, in fact, to 23 cents a share this year, and up another 74% expected to 40 cents per share in 2022. And in the quarter ended in March, reported earnings of 6 cents per share. That was a year-over-year growth of 500%, okay? And revenue of 40.3 million, up 124%. So this is very interesting. Based on the fundamentals, oh, I like this, return on equity of 81%. Okay, the debt says NA, and I'm realizing with with Market Smith, debt of NA does not mean zero, so you have to kind of go back and look at that, but that's a very strong return on equity. You've got this whopping PE ratio of 295. That could settle down a little bit. Yes, I know that's high. Growth stocks often have ridiculously high PEs, and I learned many, many years ago not to let that scare you off. Okay, let's do one more before I let you go here. Okay, progeny, fertility treatments. Okay, so yeah, this is a sign of the times as well. More and more people looking to grow their family, and you know what? With I still think we're seeing probably a lot of women delaying starting a family and so on and so forth. I haven't dug into the numbers of what is boosting this stock. I'm only looking at the charts today. I have not gone back and looked at the story. But again, you've got another interesting IPO that provides us with a good lesson here. So this one went public at 13 back in October 2019. So that rallied, okay? You had a little rally in there, not unusual. Then we had the post-IPO correction. Now, yeah, this coincided with the big February and March 2020 COVID-driven downturn, okay? That's okay. So it pulled out of that one, formed a double bottom base, broke out of that back here in November 2020, got another consolidation. I like what's happening now. I'm going to look at a daily for this one with you for a moment. Very nice support at that 50-day moving average. So far, the institutional investors are holding on to their shares, not a big sell-off. They're just buying enough to support it at that level. Let's go back over to a weekly because I find it easier to look at the sales and earnings growth over here. Now, here's something, okay, you had triple-digit revenue growth in 2019, 72% in the quarter ended March 2020. That slipped to 15% in the quarter ended June 2020. Okay, we get it. A lot of revenue slipped in that particular quarter, second quarter of 2020. Familiar story. Bounced back year over year, 62%, 54%, 51%. These are year over year numbers, by the way, not at least the percent change. These are sequential sales. And you see sequentially, other than that one quarter of decline, the quarter ended June 2020, we bounced right back to sequential growth in the following quarter, okay? And then we had a loss in the quarter ended June 2020, but then we came right back to accelerating earnings growth. 171% earnings growth expected this year to 46 cents a share, and another 39% expected in 2022. Okay, you know, this one looks really good to watch right now, by the way. Kind of liking this one as a watch list stock, and you'd be looking for it to clear this high over here of 66.61. You'd like to see some heavy volume when that occurs. Let me just see when the company reported earnings. They reported earnings in May, June, July, August. So, you know, we should see something there. In the early part of August, we should see the next report. And I'm kind of thinking that is going to give you an indication after that earnings report of what direction this is really going to go in, okay? So I would kind of just keep watching this. It's not really at a point I would say to buy right now. It is one to watch. Okay, that's what I got for you today. I got to run. I got to do a few more things this afternoon. I'm going over to Orange Theory, late class today. I usually go in the morning, but I'm going later today. Okay, thank you. I appreciate you. I'll see you soon.